All right, good afternoon, everybody. This is Gavin McGuire, event trader here, and I am being joined by Brett Manning, chart trader. Brett, how are you doing today?
I'm doing good, Gav. How are you?
Doing good, just kind of watching things play out here. So, we're just going to break into this right now, and then we're certainly going to take a look at today's action as we kind of first want to recap what's gone on since the last time we met and then talk about some of the current key items going on in the markets and then some of the signals that we are going to be looking for moving forward here. So, Brett, the last time we talked, the last flow show we had would have been on February 27th, which we were talking a lot about some of the concern we had going in around the coronavirus there. So, we did have an update around that time on March 16th when myself, you, and Scott were all on kind of laying out what was happening in the markets. And the irony is when you go back and look at that, we've basically flat since that time. So the recap that I'm going to take a quick look at, Brett, is what kind of happened in those four trading sessions after we spoke that really led to that puke drop that saw us hit the lows, and some of the things that have been going on since then in terms of what's led us back and where this buy-in has been coming from. So I think this is all concepts that we've discussed in on the page, but probably good to kind of just recap and go through that so people know exactly where we stand, as Brett likes to say, where we are now, or you are
Sure.
here. So
You are here.
the you are here, always key. And Brett, I think as we go through and take a look at some of that flow show data, we are really going to kind of see some of the bigger concepts that we're going to discuss here and what was being sold and what exactly hit the markets. But basically, from my standpoint, Brett, I think the big thing that we're seeing since we talked right before St. Patty's Day was the capitulation of a lot of different assets by managers there, particularly in the bond segment. When you go through and look at the bond data, you're going to see a lot of records about what was sold off and exactly what was leading it slower. And for your perspective, Brett, did you see a lot of that being forced selling by margin calls, some of these funds being blown up, and things of that nature?
I don't think there's any question about it. This was a multi-standard deviation, sudden, exogenously driven event. Nobody was prepared for it. Nobody had any chance of being prepared for it. We saw every kind of different strategy blow up, every kind of risk balance strategy blow up, every kind of volatility strategy blow up. There are dead bodies everywhere. So, absolutely.
Yeah, dead bodies everywhere would be a good way to point it. I think one of the things that I saw that was most interesting was margin, debt margin was not high at all going into this. I mean, usually it's somebody that got over leveraged thinking that things were just going to continue to skyrocket. But when you go through and you take a look at the margin activity going into this throughout 2019, really, it was amazing to see that that was pretty low overall. The margin debt trends were in line with the S&P 500. Where was it that I saw? The 2019 was abnormal in that stock soared, but margin debt barely increased. Was the comment that I.
Yeah. It's one of the big reasons we turned bullish in August and September and October of last year. I mean, we that was in a chart book I did in October to focus on the margin debt. There's not mom and pop leverage in the market, really, is what that says. And generally speaking, when you're in the final stages of a bull market, you get a blow off that is sponsored in large part by levering up by individual investors. And you see that most obviously in the margin debt numbers. And you're exactly right. We weren't at a crisis point of over leveraged exposure in the market, according to a lot of different measures, margin debt included. So this is really just, this is the most dramatic version I've ever seen of traffic moving down a highway in an orderly way, and suddenly there's a brick wall across the highway.
Yeah, no, I mean, and that's well put, and I think that's probably why the depth of this selling was so surprising for a lot of people. But I guess one of the backdrops that we've talked about a lot, Brett, that we saw really come through the forefront, and we'll get into some of the moves in the LQD and the HYG and the JNK, all the different bond levers. But really, it seemed to be the melt into that corporate debt concern that's always been a looming 800-pound gorilla in the room for financial markets.
Absolutely.
Okay, so we saw that kind of work its way out, and a little bit of a capitulation come on Friday, March 23rd. Now, since then, we've definitely seen a bounce back in buying. Actually, Monday the 23rd was when we hit the lows. I believe, Brett, if I recall, that is when Sunday night the Fed came out with its latest round of bazooka. I think it was the QE program of about $800 billion that failed to assuage any concerns in the markets. And
Yeah. Right.
and that was perfect into
Objection.
what you had been talking about for months, right? With your voodoo doll. You want to explain the voodoo doll theory, because I think that really played a pertinent role in the idea that we continue to see financial markets implode, and steps as drastic as they were by the Fed seem to do little to assuage the concern in the markets there.
Yeah, I mean, the basic idea is that monetary policy is an indirect tool. You have to do things a certain way to cause people to believe something, and then they take actions based on their belief in something. It's not a direct application. It's attempting to shape a context that you believe will cause a certain series of behaviors to take place. And I liken it to voodoo doll magic, because you take a doll and you make, let's say I made a miniature Gavin right here, and I took a little pin and I stabbed the miniature Gavin in the shoulder, and you saw it, but because you believe, as we all know, you're into voodoo doll magic. Many people don't know this about Gavin, but he's totally into it.
Yes, a hidden side hobby.
Yeah. No, it's very interesting. But yeah, so Gavin sees this pin go into the shoulder of this voodoo doll, and because he believes so much in the relationship between these concepts, his actual shoulder psychosomatically will start to hurt. And there's evidence of this. People who are really, really into voodoo doll magic and really, really into the voodoo culture, if they believe enough, they can actually experience the impact of being stabbed in the shoulder indirectly through the use of a voodoo doll. And it's the belief that causes a psychosomatic response in the actual body. But there's this indirectness, and the bridge between the two is the belief. And without that belief, it's not going to work. So if people lose their faith that actions taken on the monetary policy front are going to necessarily lead to a direct result in the real economy or in markets, you have to take a more direct approach, which would be, in our little metaphorical reality, me dropping the voodoo doll and turning around and sticking the pin right directly into Gavin's shoulder. And that's what fiscal policy is. It's actually doing an applied version of the same thing without depending upon people's faith or belief in a scaffolding of assumptions about relationships between different financial concepts. So we've seen my problem with this process is that we've had so much active monetary policy for a decade now following the financial crisis. That you wear that down. If you keep on stabbing doll after doll after doll in the shoulder, eventually there's going to be enough instances where people see it not working that they're going to start to lose that tether of faith. And I think that there's a process by which you can kind of spoil the necessary relationships through overuse. And I think that we've gone through overuse, and now that we're facing a real crisis, and we're not that far off the zero lower bound or the effective lower bound of monetary policy in a lot of places in the world, there was no question to me that it would have to be monstrous fiscal action. And I think we're probably, so far, we have seen just a small percentage of what's going to be necessary here.
Yeah, and we'll break down some of those fiscal and monetary policy trackers, but also adding into that decline, Brett, there's certainly the market functionality too, or as we've seen talked about the great liquidity crisis, meaning that when volatility picks up, all those low vol players, and Brett, you got deep into the weeds on in this couple of years back when you had those, what was it, the UVXY call that you were looking for that to implode, but
Yeah, SVXY. Yeah.
yeah, the SVXY. But it's basically adding to this was, and Brent and I had talked about this, starting off first the high-low ratios, which meant that there was a greater chance that some of these high-flying names would bear the brunt of a bigger pullback, and that thus kind of exasperate some of the moves lower. We saw that. And then once we saw that and the volatility pick up, we saw the volatility players step back a little bit, right, Brett? And that kind of created a little bit of a liquidity crisis that really further enforced that selling. And then when you had the CTAs piling in, that would be the the commodity trading advisor funds that work in the more leveraged areas such as options and futures, and then the vol targeting funds deleveraging, as we just said, really just exasperated this move. And finally, I think around 2200, we caught that bottom, right, Brett? Now, the question everybody wants to ask right now is that 2200 the bottom? Are we going to see a steep recovery? And I think you've done a pretty good job at addressing this, Brett. With number one, obviously there had to be some real buyers here picking up the pieces once we saw a couple of funds get picked off, right? We saw Ronin Capital here in Chicago being one of the funds that were carried out. A couple other bond redemption scenarios that we saw. And I think that led to the idea that there was the puke. We did see some of that fall out, and people were just picking up dirt cheap names here. The question is, over the last week, Brett, how do you view this buying? I know you've gone into a lot of that rebalancing in the portfolios, and we could address that a little bit here. But what is your take off those March 23rd lows, so just about 8 days ago, on what we've been seeing over the last week?
So, I mean, to add to the list of bodies, I think the risk parity model also blew up, which is another biggie, and we saw a lot of strange correlation factors between bonds and stocks.
And real quick on the risk parity, Brett, that's the second time that has blown up. Do you see?
Well, yeah, and it was early 2018 as well, but. Yeah, we're actually October 2018. Sorry,
October 2018. And we could get into it maybe another time. But do you see
very different catalyst? But yeah,
do you see that strategy kind of falling by the wayside?
Well, I mean, all it would take is a extended period of bond bear market. I'm not sure that we're necessarily there. I mean, at some point that's going to turn around on a secular basis, and then, yeah, obviously every time you have a pullback in the equities market, you're going to see it. But we've been in rather unique period for that model out of the global financial crisis, and a lot of the support by the Fed has kind of nursed that model into probably a more exceptional state than it deserved to be, and a lot of leverage has gone into it, kind of reinforcing that. But as far as looking at this next bottom, I mean, I think that looking at reality as a deterministic set is oftentimes a problem, and in this case, I think that I wrote this about the. Looking for reactions to future economic data, and I think this really gets to the same point, and that's information about duration of this crisis is going to be everything. And there's unknowns about that, and if this turns out to be a more drawn-out process where we can't really get back to normal functioning economic conditions quickly, then there's no way that we have seen the bottom. We've seen the bottom for the scenario in which we're able to dispense with the exponential curve rather quickly. We start to flatten things out. We don't have the next crisis, which would be overcapacity in the healthcare system. And we're able to move forward. We can paper over this if this is a short-term 1 to 3 month kind of crisis. But if it's a 12 to 18 month kind of crisis, let's say we have failures on the vaccine development front, we don't come up with real effective therapeutics to add to the system, and we don't do a good job of really accomplishing a collective act in a very individualist culture, and a lot of the Western world is that way. We got kind of the odds stacked against us. How we're built, how our advantages aren't really so useful in a situation like this, when really what you need is super central command from a top-down authority that has full control over how every individual acts. We're not built for that in the West, and we're suffering because of it. And if this turns out to be a process, especially in an election year here, where there's a lot of politicization about the strategies that we're using, and we end up turning this into a 12 to 18 month process before we really get a handle on it, then we've got a lot more damage to price in. But if this is the shorter version of this, if people are serious about taking a very quick, short, sudden kind of heart attack and then recovery, where we just shut everything down, we get this completely under control, and then we move forward with a new model. We don't have big problems developing a vaccine. So where sentiment data is not necessarily the best tool here, because this is going to depend on things that aren't really necessarily about how people are positioned. But what we've done is we've had a full-scale panic. We're after that panic right now, and I think that we're past the point of market dysfunction. We still have a very wide band around price discovery. It's really difficult to understand how to discount what's ahead. You've got Goldman Sachs now calling for a 34% negative annual GDP read in Q2.
Yeah, I'm waiting for
like
Morgan
that.
Stanley.
Ever.
I'm waiting for Morgan Stanley to go 35%.
Somebody's got to do it, right? 40. Can we get a 40? Can we get a 50? I mean, the markets have no idea how to process that. So what's the price of the S&P if it's negative 15% versus negative 50%? And we don't know which one of those it's going to be. The difference in the price in the S&P is enormous under those two possibilities. So the whole S&P right now is like a biotech heading into a PDUFA date.
Yeah.
You don't know whether it's going to be go or not, and the repricing is massive in either direction. So I think that trying to look for a magic technical or sentiment indicator that's going to give you that information is ridiculous. You're just going to have to play read and react. You're going to have to be prepared for the worst, be prepared to take advantage of the best. It's not an easy scenario, and there's no holy grail to deal with this situation. We can show that every major sentiment indicator is at all-time buying levels right now. But I want to caution with a caveat that that's not necessarily something that you should move on, because these are not normal circumstances, and it really is. This is, I've said several times, you could think of this like an alien attack. Like how would the markets work if the Earth was being attacked by aliens?
Which is basically what's going on.
It's basically what's going on. It's nobody's fault. We got to figure out a way to deal with it. It's catastrophic.
It's a new threat that nobody knew was coming, and
right.
And it's great that, and we'll break into some of those sentiment trader points on you. But I think today's a perfect example, Brett, of like try not to read too much in, because we had the Chicago PMIs, right, the consumer confidence numbers. We could also couple in the China PMI numbers here, where all of them came in well above expectations. But
let me just make one final point in that rare, which is everything is going to come down to things that give us leading indicator sense of duration. And I think that that's all you have. And I think that those factors are going to be things that aren't typically something that financial market participants look at. Like what's the influenza rate growth? I think that that's an important leading indicator for how this is going to go. How well are we going to distribute testing? Those are things that are going to have direct implications for how quickly we start to move back into a market that's trying to price in things that it can understand at all.
Yeah, and I mean, it's just going to be so tough because you're really trying to model something that you don't have any sort of historical performance to go off of. Right. So, I mean, just in terms of the testing and everything, because even, I mean, you can look back at the Spanish flu as much as you want, but I mean, we didn't have the data to be able to follow exactly how that played out in terms of testing, like Brett said, and we certainly have a lot more on the pharma front in terms of vaccines in order to battle.
We're in an infinitely different universe now, 100 years later.
Exactly. So we have no model to go off of here. But
what do you think? Let me ask you, what do you think of some of the economic depth projections that we're starting to see over the short term?
Over the short term, I mean, I think a lot of people are just going off of China's numbers that we've started getting back so far. And I was talking about this morning. I know some people were concerned about the legitimacy of some of those numbers. I know that there is talk that China hasn't been taking in asymptomatic users and things like that. So, we're trying to go off of China, but I don't think a lot of people are trusting the data that we're getting out of China, and that's one of the things that I was pointing out. Not trying to make it political at all or anything like that, but just what people are looking at to go off of. So I think some of the projections in terms of the GDP numbers from Goldman Sachs that we've been seeing, uh, they're all fine. And I mean, we kind of saw things play out. I would say the initial claims number was probably the first real shock value number that we got out of the U.S. data, and that was a projection of. I know we had a consensus of 500,000. I don't know if that was. Uh, how accurate that was, but I know the briefing.com consensus was 2 million, and then we got a number at 3.3 million, and I thought the important thing was that the market did digest that pretty fairly well. So it kind of goes back to the depth versus duration argument that you've been making. That's okay for right now. We could accept an unemployment rate. We're going to be getting the March jobs number out on Friday, right? We can accept that big spike up in unemployment. It's how long does that stand for that's really going to be the key thing. And
Well, in a related question, then, tell me this. What do you think? Let's say we have this kind of sudden stop cardiac arrest economy. For how many months can this go on before we start to get to the point where the tools that we have, fiscal and monetary, can't really continue the guise of being able to deal with it and maintain a bridge from the past to the presumable future that happens after this crisis is resolved?
for me, I
How
think
long?
For me, I think a lot of it depends on how well the Fed could keep the short-term funding rates function. And I think if you get past 3 months and there's been no signs of activity recovering, then I think you start seeing that short-term commercial paper markets kind of falter a little bit. I mean, right now, I believe that people have accepted this modern monetary theory from the Fed, which is basically what we're seeing in play with the QE infinity and doing whatever it takes. They'll allow that to go for 3 months, but I think if it starts going longer than that, you're going to start seeing faltering in that commercial paper market. You're going to continue to see debt issues arising in the corporate area that just simply aren't going to be able to be covered no matter how much the Fed is saying, because I think at some point that people are going to look at it as just being funny money and not really having any value. And at that point, I think you start seeing inflation start to skyrocket. And because
What about what about the banks in terms of the liquidity position coming into this? I mean, I know that's we've talked about the dominoes. I think the dominoes are probably kind of central to this argument. If we can cut off the initial first wave of problem, which is surely the service economy, employees in terms of what their obligations are and their ability to remain kind of afloat. But if the dominoes start to proceed at all, I mean, I know obviously policymakers learned a ton that's applicable here from 2008, 2009. If we
right.
hadn't gone through that first, we would have a difficult time now. But what were the banks' positions coming into this situation? And I mean, given what we learned 10 years ago plus, how likely is it that by stretching this into more months than we'd like to, that we start to see problems in terms of counterparty risk in the banking system?
The banks are very well situated right now to deal with with this shock. What the bigger concern is probably in the non-financials and the shadow banking areas that we are unaware of, like the insurance companies. All these companies, anybody that was covered by the CCAR, any of those major money institutions or the banks with over 50 billion in assets. They've all gone through the stress tests for scenarios similar to this. None of them were priced in for a 24% GDP drop. But again, I think that the Fed's done enough to kind of gloss over that for 3 months. But one of the other things that we need to get straightened out here is we can't have the oil and gas sector just completely fall apart with this oil battle between Russia and Saudi Arabia. I think alleviating that stress could go a long way, and you got to figure that the G20 leaders are all talking with the Saudis and Russians, trying to get them on the same board, basically saying now's not the time to drive the global economy off the edge with this. So I think that plays a key factor in how long these banks are able to withstand this shock. But they were extremely well positioned going in. Their balance sheets are in great shape. But, Brad, when we go through this Q1 earnings season here in a couple of weeks, everyone's going to be thumbing through those credit issues. Looking for a jump up now. They might not be shown as much in Q1 as they will be in the Q2 numbers, and that's kind of why I look at the 3 months, because if we're sitting here going into the end of June and the end of Q2, and we still haven't gotten the economy back on, you're going to see a lot of these banks kind of bursting up with their balance sheets, because they're just not going to be able to take the mortgages that aren't going to be getting paid, the student loans that aren't going to be getting paid. Now, again, a lot of them sold off their student loans, but you're going to see Navient and Fannie and Freddie all of a sudden come under a lot of pressure. And again, it's going to be up to the Fed to kind of step up and buy a lot of this paper, which they said that they have. But at some point, for me, Brett, I don't know if you think of it this way, that turns into funny money, and then for a fiat currency, that's kind of the worst scenario that one could imagine.
That's exactly the way I've been looking at it. I think that effectively the Fed they've created a number of new facilities which add up to what I consider to be kind of like if you think of the credit system in the economy as like an organ, they've done an organ transplant with the Fed at this point. They've got now like an artificial heart. For the entire credit system, there's now an artificial credit system that is currently in place while we try to heal up the original one, or keep it sort of like in a chamber next to the surgical bed. And we put the Fed in there in place of it, pretty much across the board. And yeah, I think that you can do that. The Fed has an infinite amount of ammunition in that direction. The only boundary to it is when the concept of money starts losing meaning. Because if you think about it, if you extrapolate it indefinitely, that would happen at some point. If you're just making money out of thin air to cover every single obligation, at some point, the whole concept kind of breaks down. And that's exactly what you're talking about. That sounds like something, a gold bug conspiracy theorist would have said 10 years ago, but the fact of the matter is that's the reality we're living in right now.
Yeah, and I mean, you're still long the GLD, right?
I am not.
You're not.
But
okay.
I'm kind of watching it closely, and I'm considering a reentry.
Yeah, because I bought some GLD just from the standpoint that either we get that scenario or we do see a bounce back, and again, I see inflation really kind of skyrocketing there if they're not able to pull back, all the prosthetic limbs here quickly enough. So, I just see gold as potentially a winner either way. But I think, Brett, you would agree with me on this. The duration, like I said, 3 months I'm throwing out there as because then we start running into the end of Q2 and we're going to start seeing a lot of the banks warning about the pickup in credit issues, and that really starting to hit the balance sheet. We could certainly see a lot of home equity lines of credit and credit lines from energy companies all being pulled, and that could be a little bit of a mini run on the bank. But I do think that the one thing that could alleviate this, if there is some sign of hope of a vaccine coming.
Yeah. Now, if you go back to the oil sector and the implications that has for the banks, I'm not sure if you remember early 2016, one of the big concepts that we talked about back then was what's called redeterminations.
Yeah.
You remember that term? It kind of dropped out of our lexicon, and now it's probably going to be really important again.
Yeah, well, that process should have already started. Am I correct in that?
It should have already started, but after the price crashed, which means the value of reserves in the ground is being priced right now for North American oil companies who have heavy debts and who produce at a higher price than this in terms of, any kind of margin. Like you've got a lot of companies right now that are the banks are deciding whether or not to extend them more credit based on the value of the reserves that they have in the ground according to this current price of oil. You see what I'm saying? So
it's an asset-backed security.
Yeah, exactly. And all of that generally happens during March.
Yeah.
There's spring redeterminations and then there's fall redeterminations. So if you're an oil company, you go to the banks and you say, let's, for the next 6 months, we need such and such amount of credit. The bank decides what it's willing to do for you based on the assets that you own. And the asset that you own primarily is the oil that you have in the ground. And they value the oil based on the price of crude oil at that point. And it's just, when this crash happened for oil, was probably right in front of establishing the reference price for the
No,
spring
no,
redeterminations.
no surprise that the Saudis and Russians would try to do it
No,
before that,
I'm
right?
sure that's absolutely part of it. And I don't really think of it as a war between the Russians and the Saudis. I think that it's more a war between the Russians and Saudis on one side and the U.S. shale companies on the other, because that's what makes life difficult for them. But
I found it interesting too, Brett. The Pioneer CEO was on I think it was Mad Money last week, and he had said that the big oil companies are also in on this, trying to squeeze out some of the smaller players. You got any thoughts on that?
well, I mean, it's all market share.
Yeah.
So, I mean, if you just look at it as a big game theory landscape, then obviously the incentives are spread out that way. I don't know what actually is happening culturally or what the people are made of, but that's, obviously, if you look at the future of oil and how oil is going to be valued and how people have different points of control over that marketplace, then, most of the larger established players would want to have greater control over the marketplace and have greater profits from what they have on the ground. And a lot of the smaller participants that are able to get in when oil's at a higher price and they're able to turn that into a sudden flood of supply would be a thorn in the side of that process. So it's not an absurd idea, just looking at it in terms of its logic.
Yeah, and I do think that this redetermination has really been a key overhang for the energy, and it's difficult to see markets really just popping back until this is kind of put on the sidelines, don't you think, Brett?
Yeah, well, and yeah, I mean, just to kind of summarize that point. So what we're talking about here is companies who are already in a lot of stress, who are smaller players with relatively high cost production in the oil space. They've just probably had their access to credit sharply reduced, which is the banks doing something that they need to do to maintain their own solvency through the summer.
Right.
So it's kind of kick them when they're down, because
And
it
this
just
is
so happened to be an oil price crash right before we found a reference price for deciding how much the companies have as far as assets.
and this comes when they're dealing with demand and supply issues. So
Yeah, it's a real deadly combination.
a perfect storm, if you will. But so we'll obviously the banks are going to be a key item to follow moving forward here, Brett. That's for sure. We'll be talking a lot about them going through earnings season, but that's another problem too, I guess, Brett. Right when you're talking about that price discovery and trying to figure out, okay, how are we going to
Yes.
value the S&P? How are we going to value these individual companies? I don't know if you saw this, but I believe the SEC has delayed that 30 to 45-day reporting period that companies will have. So we might not even get a Q1.
I think I lost you there for a second. Can you say that again?
Yeah, so the
The
SEC
SEC has.
has lifted the 30 to 45-day reporting period for companies in Q1. Now, I haven't seen if they've come
Okay.
out with a new reporting period, but there is a chance, an outside chance, that we might not even really have a Q1 earnings season.
I mean, what difference does it really make? It's
Yeah, I.
it's the depth versus duration argument. It's just like why negative 34% GDP or 3.3 million 1 week jump in claims. All these things don't necessarily matter all that much if we're going to print $6 trillion and put the entire credit side of the economy on the Fed's balance sheet as an organ transplant temporarily. Because again, what really matters is what are these numbers going to look like in September and October? Are we back to business? Is everything okay? Have we bridged across this? Because the depth of the chasm we're bridging across, I'm not sure it's really relevant. How horrible, because it's going to be horrible. Every number is going to be horrible for March, for April, etc. Question is it horrible for September, November, next January, or not? And I think that's really the only question that matters.
Right. I mean, it's no different from if a company took a huge one-time legal charge in a quarter.
Exactly right.
You know,
Doesn't say anything about their fundamental value as a business over the long term.
right. So with that, some of the sentiment survey, Brett, and I think it's important, again, you mentioned this. Um, we have a lot of stuff in the overly pessimistic, and we'll take a quick peek at some of them. But the key thing for you on this sentiment data is simply you're not really giving it too much credence, as opposed to, say, December of 2018 when all these were screaming alarms for you, correct?
Correct, because again, if you look at it just by analogy as like the entire S&P is a biotech coming into a PDUFA date, sentiment data doesn't matter in that situation. There's very real exogenous inputs that are going to define the future, and there's relative vulnerability factors. If we have everybody in the world short, and we get really good news, the strength of that rally will be greater than it would otherwise have been. But understanding the overall direction of whether it's going to be a rally or a decline is going to have more to do with the evolution of things in the world than it will with how people are positioned. But there will be magnitude factors that are definitely driven by sentiment, how people are positioned, if everybody's all leaning one way. Right now with the price discovery process, I think that what we're seeing right now is we're going to wash from one side of that spectrum to the other relatively dramatically and relatively quickly as the market makes big kind of swinging moves one way or the other as we're trying to figure this out. So there's probably not going to be a real obvious catalyst. However, I will say one caveat to all that is we are seeing a lot of data points that suggest that people are positioned for this to be, a kind of end of the world kind of situation. And if it turns out to be the case that we've gotten serious about this fast enough, and this turns out to be a situation where we're really past the extensive threat. We've come up with new systems. Perhaps there's even new innovations, not just in the pharmaceutical space, but also maybe in, even in some ways technology can possibly help in ways we can't even imagine right now. I mean, this is a very innovative culture with a lot of money in the hands of a lot of really smart people with a lot of, really advanced computer science degrees and working really hard. You never know what's going to pop out of the woodwork. That can just completely surprise you and overturn the situation in a lot of ways that can't be predicted. So who knows? It's possible that this turns out to be much less dramatically severe than it seems in a simplistic evaluation, and the markets are probably positioned to extrapolate in a more simplistic reasoning. So it's possible that sentiment data, to the extent that it's showing a panic, and it certainly is showing a dramatic opportunity if you're an optimist about our ability to kind of find some new pathways out of the box we seem to be in right now.
Okay. Brett, while we're on right here, we might as well get your take on this. Looks like there's a tweet out saying that President Trump's looking to delay some of the upcoming tariffs. Not really seeing much of a bounce from that, from my opinion. Again, we're kind of in a little bit of no man's land, but also I think people would want to see a little bit more detail. I mean, it's fine if he defers some tariffs, but if there's not going to be any demand for these products, how much of an impact could it potentially have? You got any thoughts on that 1449 SPY headline on the page?
I mean, I just don't see it as being all that relevant because I guess you're looking at a situation where, normally I would say a policy change can be sticky past the crisis, and that tends to be a way to look at the situation. Like some of the new things that we're doing right now across the board are things where, they don't get taken back very quickly if things suddenly turn out to be better than expected, and they hang out. Like, some of the stuff that we see with the Fed doing, if things turn out to be less catastrophic than they appear, then, the Fed's not going to take any of this back until there's inflation. And that could be a ways off. So you end up with this kind of sticky stimulus hanging around past the crisis. But in this case, I'm not sure that really applies logically. Like, I think that the second he can put the tariffs back on, he will, and he's already put a time frame on it. So, I'm not sure that it has any direct functional impact on the situation, and it doesn't seem like it's going to be something that sticks around post-crisis. So I'm not sure it's really necessarily. I suppose it's just a piece of directional news, but I don't think that it has any obvious practical impact.
Well, we see Scott's putting his vote in for this as he just jumped into IWM swing short. So looks like he's looking for a little bit of end of the day selling here with about an hour left of trade. But Brett, with that, so I think there's a pretty important dynamic that you were discussing earlier that we're going to get into here now. But first, with the overly pessimistic sentiment readings that we're getting, and then we're going to run into your tape composition model. Of the overly pessimistic, some of the areas that we follow that were on there, the New York Stock Exchange high-low, the SPY liquidity premium, the asset investment management editorials, the robo put call ratio, small trader put buying, inverse ETF, risk appetite, VIX term structure, and equity hedging. These were
Right.
all in the overly pessimistic range. No surprise there. And then the only thing that was jumping on to the overly optimistic was the mutual cash fund levels,
Which is a
uh,
3-month lag,
which
so it's not a relevant data point.
which
I'm sure that that's not true anymore.
exactly. So I was a little surprised that Lobo wasn't in on the overly pessimistic. That was actually neutral. But out of curiosity, which of these levers or which of these metrics do you find the most important?
I mean, we're still looking at just an insane SPY liquidity premium. So there, people are just there. There's liquidity issues. There's all sorts of issues that would cause people to want to be only in the most liquid things. It's one of the reasons why you saw precious metals implode. You just don't. Money is moving only into things that maximize optionality because we don't know price discovery. If you don't know the value of anything, the most important thing you're looking for is the ability to get out of something that you get into because you don't have any idea what it's going to do. And there's no ground here. There's no one thing that's truly the sidelines because the dollar can change dramatically in value and the volatility of currencies has gone through the roof. So there's no place where you're on dry land. Everything is at sea and it's moving in different ways. So the main thing that you're going to flood toward is something that gives you the greatest ability to flood away from it. And that's what liquidity really is. So people are pouring assets into things that give them the greatest allocation optionality in any future scenario they can envision. That's what's guiding a lot of what's happened in markets over the last 3 weeks. So, of course, that means that everything is moving just into the big index ETFs and futures, and everything is moving out of individual stocks. The individual stocks get second-tier flows as being a part of the indexes. But, you can see such a dramatic move in some of these things. It's really just highlights the sense we've been talking about, which is there's no confidence in price discovery, and that's why I kind of refer to it as, the entire market is a biotech in front of a PDUFA date. It's just there's that kind of binary outcome possibility, and everybody's going to really be hanging on any clues that start to give us this idea about duration. But the rest of it is all just, of course, as you would expect. If I wrote a fictional story about this situation, I would easily be able to predict all of these things that we're seeing in sentiment data, but it doesn't necessarily mean it's something that's worth taking action on, because of course it's the case. Of course everybody is buying tons of puts and moving to the most liquid assets and, balancing their portfolio with, huge exposure to cross asset flows and inverse ETFs and all sorts of stuff like that. And I think that's on your end.
Yeah, it is me. Hold on, sorry about that. There we go. Yeah, and I mean, so this kind of all falls into your positioning, which you had your tape composition model that you posted a link to back on 1333 for anybody interested in following along. I do have it up on the page here, Brett. But you want to give a quick rundown of exactly what that is and where you kind of see most of the people squirreling away right now?
Yeah, so I mean, it's just kind of like a broad heuristical kind of tool that I just, I gave explicit existence to a couple of years ago, but it's been kind of something that's, a part of the way that on a gut level I kind of deal with markets all the time. I'm trying to categorize people into essentially, there's a couple of different levels to it. There's the strong hands and there's the weak hands in anything. And so if you have people who are bullish, some people are bullish in a strong-handed way, some people are bullish in a weak-handed way. People who are bullish in a strong-handed way, they've got fundamental reasons. They're willing to buy more if the market goes against them after they buy. People who are weak-handed longs, they're generally going to sell if the market goes against them after they buy. You can look at the opposite for shorts. Some people are short the market in the way that Jim Chanos was short Tesla, where, he was short at 300 and he was still short at 900. And apparently, he didn't see a difference between those ideas because the company's worthless. There's very few people who are going to play that kind of hand on the short side, but there are people who do that. So, or else perhaps it's part of a larger kind of, composition of positions where it plays a role, but it's not the defining naked exposure. Either way, there are strong hands and there are weak hands on each side of the market. And then, they're either in those positions or they're hunting for those positions. So the difference between, let's say, a strong long holding and a strong long flat in my model, which, again, you'd have to be looking at the link. I'm not going to read every single word of this, but a strong long holding is a strong-handed long side participant who's already bought into the market, right? A strong long flat is a strong-handed long side participant who is flat, but who's actively looking to buy. So let's say you have lots of the latter kind, you're going to have a bid, right? You're going to have people who are transitioning to flat from long, or to long from flat anytime you get any kind of positive news or a positive development. So that's a good situation when you get something where you've got a sentiment panic, like the one we've seen now, except maybe not quite as driven by an exogenous event. You tend to get a lot of strong longs flat and weak shorts holding. And those two ideas, those two dynamics together add up to a giant freaking squeeze. Like that's the recipe for it. When you've shaken out a lot of strong-handed longs who finally capitulated, like we saw in late 2018, early 2019, we had just kind of gone through this process where we had shaken the market to its core. We got a big dive. And you could feel the sense that there were a lot of strong-handed market participants who capitulated out in the course of that move. The second we got the Fed to reverse course and say, it's no longer tightening, Powell is no longer going to be somebody who's just going to, go against the sense of what the markets want. He's going to cave to the situation. They're going to reform their policy direction. They're going to start cutting, whatever else. You get this situation where there's lots of people who are weak-handed shorts who are actively in positions. Well, the only thing that a weak-handed short can do, if it's a weak-handed short who's holding, is buy. That's the only action that can be taken there. That's a potential buyer. Strong hands who are longs, who are bulls, who are out of the market, long side only portfolio managers who've been shaken out into cash, people like that. The only thing they can do is buy. So you look at whatever the potential moves are by any of these categories. You try to understand what the market's made of now, what the tape is composed of, and then what that implies in terms of the sorts of orders that are most likely, given different, prospective possible catalysts. So right now, I would say that we've got a ton of strong-handed longs who are flat. They have been moved, they've been shifted into weak hands and then kicked out of the market. We've got virtually no weak longs holding, though that's probably risen over the past week because we've got people who are maybe willing to speculate on some of these values. We've probably got a lot of weak shorts holding. We've probably got a lot of people who are fading this bounce because the news continues to be terrible. We're only heading for bigger death rate numbers, given kind of the incubation period and the cycles that we're in. There's lots of reasons to try and fade this market. So we probably got a recipe that if we had some game-changing positive news could really lead to a massive squeeze in the market. But then again, as we've talked
a couple in the Fed stimulus too there, right?
Sure, but as we talked this entire time, sentiment data and even these positioning ideas can't necessarily tell the story because the facts of the world are going to be so much more important. And if we are looking at a situation where the duration of a negative 34% GDP number, if that's not just going to be something that's like a couple of months, but we're going to see that for, the next year, then none of that really is going to matter. So people are positioned conservatively. I don't think there's any question about that. But as you look at the link that I posted, this will give you this discussion gives you at least a little bit of idea of what I meant by that. And again, it's not a precise tool that I use. It's just sort of a framework for thinking about markets. There are these different groups of participants. There's a difference between a strong hand and a weak hand. There's a difference between somebody who is aligned on the bullish side and aligned on the bearish side. And there's a difference between whether they're currently exposed or not. And that kind of results in these sort of 8 groups. And you can think about the market in terms of that. It's a useful way to parse through the chaos of markets and get some kind of organizing framework in place to just kind of think about, well, what if this happened? What sort of market are we in? What does the sentiment data tell me would happen if such and such catalyst were to appear? So that's really all it is.
All right, and always a good way of breaking down and thinking of the markets. We got about 10 minutes left here, Brett, so we can break into some of the flow show data. I don't think any of it's going to be overly surprising and really just kind of reflect what we've been talking about. But from some of the numbers, and this is based off of the March 26th flow show from the Bank of America, but a record amount of money flowing into cash, 234 billion into cash. No surprise there, right? A record 109 billion redemptions from bonds. I know I had a couple of bonds that I got forced into redemption in my mutual funds last week. Brett, did you see any of that activity?
Yeah, sure, absolutely.
So again, this kind of all fell into that forced selling. We saw 26 billion come out of equities here. 700 million into gold, despite that being a safe haven status. Do you think that has more to do with the liquidity that you've talked about before, Brett?
Yeah, no, I mean, I think that the gold has taken a hit when it has taken a hit because of liquidity issues. But I think there's no question about it that people are speculating into gold for the ideas that we talked about previously, where we are, in uncharted territory, unquestionably, in terms of how we're managing the world's reserve currency.
All right. And then on March 20th, we actually saw the record, how was it? A record 34.6 billion of redemptions from bonds on March 20th alone. And that, again, you can kind of see that, as I'm just glossing over it, as that final capitulation. That was when everybody was forced to really sell into there. Equity allocation, Brett, that plunged to 52%. This is the lowest since February of 2013. If you were curious of what was going on in February of 2013, we had the Italian elections, and a lot of people were concerned about the Italy exit at that point. And we were also coupled in with a budget impasse in Washington, where
Yeah,
people were
it was the most dramatic version of one of those I think we've seen.
Yeah, exactly. Debt increased to 25%, which was the highest since April 2014, which, again, that's when oil plummeted and we had lower rates going on at that point. Cash levels on the holdings, that was at 15%. Now, I do think a lot of the debt increase, too, is just the fact that equities were simply outselling debt at that point. Is that how you view that?
Yeah, no, sure, absolutely. One thing I'd like to point out is that all of this data is from, I believe, as I understand it, it's Bank of America's, B of A's
Their
private
show. Correct.
Yeah, well, no, but it's inside of their prime brokerage service. So
Right.
it's not in the entire world. Think of it like a sampling, like you use to understand what's going on when you do a poll to see which candidate in an upcoming election is most popular. You don't call everybody in the state, but you do a cross sampling of
Right.
the situation. So looking at what B of A has seen from its prime brokerage clients in terms of how they're moving money around is a pretty reasonable indication of what people are doing across the entire spectrum.
Exactly. So we're basically extrapolating the data from this. Um, Positioning was the positioning surprise was bonds, not stocks, were falling. Their Sharp ratio for their assets under management fell to 0.03 from 0.57 in bonds, Brett. So again, you could see the amount of forced selling that was really coming into play there.
And another side of that, I mean, the risk parity trade blowing up,
Yeah,
effectively.
yeah, exactly. So it really plays out in this data, and we've seen it recover, but there's still certainly threats out there. Again, with that oil and gas space that could really force some knock on bankruptcies in that space. We've got the corporate debt issues playing in. So this still remains the key area for us to follow moving forward here. And while we're talking here, Brett, just seen a notable sell-off in the markets as the S&P is now broken down, and it's coming back in towards that 2550 level here.
I wanted to catch this earlier, but I ended up shorting right in front of Fauci. And I had was that a scheduled CNN appearance that he had? I mean, is that something we're going to be regularly contending with?
Well, from my understanding, they're supposed to be doing a 5 p.m. Meeting today where they're going to give the projections of the death tolls and where they're coming from 100,000 to 200,000 people.
No, I know, but are we going to start seeing Fauci pop up on CNN at 9 a.m. Central, 10 a.m. Eastern, right after the market opens, giving projections? Because I think that he's seen as, probably the most credible voice on the planet where this is concerned. And if he's going to pop up
he's running
second opens.
He's running second to Cuomo right now, actually. And
yeah. Well, either way, as far as making projections about infectious diseases, he's kind of the most renowned and respected voice on the planet. I was not prepared for the possibility that he would suddenly we would see the news wires full of comments from him on CNN a half an hour after the opening bell. And that's a new dynamic, and I'm wondering if that's going to become more regular. Or maybe it's when he has positive things to say that's going to happen.
Well, I definitely feel like we're at a point where there's so much headline risk given the uncertainty around the next direction that we are in a position to see a lot more volatile moves up and down from here, and we're kind of getting a taste of that this afternoon at the moment. But
yeah, sure. We're going to see some rough data, even though if you pan back, we're seeing improvement underneath the surface. But I think that it's one of the reasons why I wanted to short this morning is I think that we're going to go through some difficult times digesting that data because it's going to start to look much, much worse, even though on a second derivative basis and looking around the next corner, there's actually a way to kind of understand and construe it as some positive signals that we're getting right now underneath the surface. But we're going to see the deaths are going to go through the roof because at this point we've started to see the spread to the point where, it takes you a few weeks if you're going to ultimately have a very severe case of this and possibly even die from it for that to start happening. And we started to see the case numbers balloon just over the last few weeks. So that's really going to start to step up.
Well, I think you're going to have to see something along the lines of what you see with Powell or any Fed chairman, where they're going to have when he's scheduled talking on any of these economic calendars or any trade calendar for certain, because that's obviously going to be a headline risk for any trade.
Well, that's kind of what I was asking. Did you see any kind of scheduling effort to be made to understand that Fauci is going, because you're exactly right, he's going to be kind of almost like if in terms of how it's going to impact the market.
Yeah, I've not seen anything. I don't know if you could go into the National Institute of Allergies and Infectious Diseases and if they provide a calendar for his appearances, but I could be sure, given the market sensitivity to this, that his every whereabouts is going to be followed by people moving forward.
Yeah.
So, and that's just going to be an extra dimension that you're going to have to take into play, especially if you're looking to day trade the futures and all. So, but I'll do my best to try to keep on top of that, Brett, for you. But
well, thanks, Gavin.
Yeah. That's the only thing that I could think of is following that NIH site and seeing if he can't get anything, because he's certainly going to be able to move markets with his commentary.
Yes.
All right, Brett. Well, I think we're just about running up into our hour here. Before we go, is there anything you want to add on? You want to wrap us all up here in a nice tidy bow, or what do you got for us?
I think the big picture is price discovery is going to be an extremely difficult process for the market as a whole. And again, everything that's going to have big dramatic implications for the market is going to be something that speaks to what the duration of this kind of crisis level process is rather than the depth of it. And you're likely to see a number of instances where the depth becomes striking. And it's it's going to be difficult to not react to it, and it's going to be interesting to watch the market, I believe, not react very much to it, which is similar to what we saw last week for the unemployment claims number. Unemployment claims number is going to become one of the kind of premium data points, probably more important than a lot of other ones at this point, because it's going to be so closely tracked and so real time as far as, a leading indicator on the economic depth of the crisis. But again, it's not really necessarily going to have that much of an impact on how the market trades, and everything, including anything that comes from Fauci or anybody else who's seen as kind of a missionary in this process and an expert that's got legitimate credibility, is going to probably have a much bigger impact, including projections for the virus in the fall, which is what he talked about today. I don't think sentiment data is necessarily going to be that useful of a tool right now, unless we get a change in the environment. If we get a change in the environment, if we see some kind of, let's say we were to come up with some kind of miracle therapeutic that really shifts in terms of, again, we've talked about this before, but everything really does, it's not the death rate that's the big problem here, it's the hospitalization rate. It's the fact that maybe 10 to 14% of people who catch this end up needing some kind of intensive care, and we don't have anywhere near the ability to provide that much intensive care, at least at this point, if we see this spread to like 10% of the population, which is completely overwhelming the capacity of the hospital system at that point. That's really the big dark boogeyman here, is getting to the point where this spreads to where we start to completely overwhelm the hospital system, and then we're looking at a death rate that moves higher, not because this is fundamentally that deadly a disease, but because we just don't have the healthcare apparatus in place to be able to deal with people who are falling severely ill from it. So I think that's really going to be where the point of greatest impact is on the market, is the duration of that kind of tenuous balance point. And I think that
what
shorter
are you looking
term,
at, Brett, then is the number one thing, daily new cases?
I am looking at the curve on day-to-day change in terms of the number of infections, given that we've passed the threshold where the testing is widespread enough that that number has become meaningful. And I think that we've gotten there now. So we've started to get to the point where the numbers that we're putting out are starting to get meaningful in terms of how many new cases there are, because anybody with symptoms anywhere is starting to go get a prescription and get a test. And the tests are getting faster and faster to execute. And over the next couple of weeks, that's certainly going to be the case as we get some of these 45-minute and 5-minute result tests in. We're certainly going to get a really clear sense of where this disease is and, how fast it's spreading. And I think it's the curve. Are we seeing a continued shift of, the jumps from one day to the next continue to follow an exponential path, or is it starting to roll over and it goes linear and then it starts to flatten? And when we start to make that shift is going to be everything, because if we do that when we've already got 2 million cases and 50,000 deaths, then we've massively overwhelmed our healthcare system, and we're going to start to see a lot more of an impact from this whole process. But if it's happening now, if we're already starting to roll the curve over, we're already starting to move away from exponential growth and into linear growth, and then eventually to flattening growth, that's what Fauci was talking about this morning, that there's some glimmers of hope there. That's what I was talking about yesterday when I said there's some blue peeking through the gray. You see it in places across Europe and in the United States, that we're shifting maybe from an exponential growth curve to a linear growth curve. Then that starts to take the pressure back off in terms of, are we going to need to, how much of a capacity overwhelm is this going to be for the hospital system? Because again, you've got maybe 50 ICU beds for every 50,000 people. And if, 10% of people get this, then you're going to have 95% of people who can't get the care that they need. And that's a recipe for catastrophe. So if we can shift that curve fast enough now, while we're still dealing with what is, even though it's tragic, still relatively low numbers, then we're looking at a short, sharp drop in economic activity as everybody sits in their house. Speaking
of which, Brett, just seen a headline that the Texas governor is issuing a stay-at-home order until May 4th. So that's the longest duration that I've seen so far in terms of a stay-at-home order, right?
Yeah, and we're starting to see it spread across the political spectrum now. So, yeah. and Colorado and Georgia are going to be in the mix probably pretty soon. Florida's an interesting outlier. I don't understand how that's being handled. My parents live in Florida, and if there ever was a vulnerable demographic, What's that?
I was going to say that's Florida for you, though, right?
That's Florida's a little crazy, but if there ever was a vulnerable demographic,
Yeah.
given the age-related implications here, and then to see them be so cavalier about it, and now they jump from being like 15th on the list to being 6th on the list in states just over the last week, like it's roaring there now.
Yeah.
And you think with 90% temperature or 90-degree temperatures, which is where it is, that's not a great implication about seasonality.
They're actually fifth now too.
Yeah. Okay. So they're just flying, and there's not very many steps being taken there. So that's difficult to swallow. But
yeah.
I mean, this is either going to be a short, sharp thing where we paper over it, everybody gets real serious, real fast, we get past it. And again, like Bill Ackman said, it's not a heroic effort. You sit in your home, you watch Netflix, you order delivery. Like, this is not hero's work. And if we can get enough resources out to people to make them whole during that process, that's not so bad. And it's certainly a heck of a lot better than 12 to 18 months of going through this process where it's just sort of half measures and stops and starts and we ruin the economy and don't stop this. So, I mean, I think that duration is going to be everything to the market, everything, and it's going to be more important than sentiment data. It's just how long is this process going to last? And if you just let me give you a thought experiment. Let's say we were living in a perfectly dictatorial society, not that there was a complete dictator, but that the dictator actually had complete control of how every single person acted in that entire country. It's a terrible place to live, but it would be able to deal with this better than any other place. Right? The dictator simply freezes everybody in place more than 6 feet apart for 2 weeks, and it's over. A bunch of people die, but it's over. In 2 weeks, it's done because everybody is frozen apart far enough that they can't spread the disease from one to another, and that's it. That's the ultimate in dealing with this, and it's the exact opposite of how Western culture is generally shaped, which is the tough thing to get past here. We're dealing with individual liberties as our primary point, rugged individualism as a culture, in an election year, in a democracy. So it's kind of everything is stacked against the most effective possible path. Again, to be held to live in a society like that, and there's nothing, deeply philosophically right about that. But just from a purely practical standpoint, how do you beat this kind of situation the fastest? It would be perfect control over everybody who is forced to do exactly that. And it would be over like nothing. But we're going to try to find some balance between those ideas, and I think that people, taking dramatic action quickly and for a short period of time is better than, taking less dramatic action, ending up with much worse results on the healthcare front and also dragging this out 12 to 18 months. And I think the market is going to be focused on that more than anything else, is figuring out the degree to which we're able to approximate that best case scenario.
Exactly. So well said and well wrapped up here, Brett. Would just note we're getting a small little bounce here in the markets, about 17 off the lows in the S&P. Any overnight action that is going to pique your interest as we get that rollover into Q2, starting tomorrow with April 1?
Well, I mean, the rebalancing should be over, so if you've been riding a bid there, I don't know. I know there's been some suspensions of rebalancing, so I don't know how much the read-through is there. And I don't have real-time enough data to understand. I suppose that some, pension funds and
I saw a lot of the California were done because they also postponed the rebalancing of the indexes too, right? Which makes it a little tough for some of the.
Yeah. So some of these factors, I don't know whether that makes a diffuse effect or if it suggests that the strength was more real. And, even into April than otherwise. I mean, the degree to which we're trying to scope out the fact that the market may be kind of discounting that we're going to deal with this better than people think, that would kind of be what we'd have to read out of the situation here if there wasn't as much of a rebalancing effect as people think there was over the last week. You see what I'm saying?
Yeah, no, I hear exactly what you're saying. Was this real buying or was this simply rebalancing? And that's something that's going to take a little bit longer.
Yeah, rebalancing is going to end, as we get into April. If there wasn't as much rebalancing as people think there was, then there's a more important bid that's been in play.
Yeah, I'm certainly on the more cautious side at this point, given the recent run we've had. So I'll be looking for opportunities to play fades myself, particularly if we get some sort of headline pop, depending on the headline, of course. But
now, what I would like to see is 2,700. That's been a level I've been looking at for a while, and we haven't gotten there. So I was really kind of set up around a strategy of letting the air, move out of the short position for the broad market until we saw a squeeze up to 2,700, then starting to look to reposition
Which basically would
for
have
a
been
for a
that
big retest trade.
right, which would have been that big break below the March levels when we were trying to find support there.
Yeah, pretty much. I mean, I just look at the long-term charts; it just sticks out to me in a
Yeah.
kind of gut feeling way. That's just everything is around that kind of zone. I'd like to see a squeeze up through, a failure, some signs where we get some positive news. The market can't rally quite as much. We start to roll over and then play like just a big retest strategy.
Yeah, especially if we start getting into earnings season right around then, and some of the concerns around credit really starts to pick up
Yeah.
as these numbers and valuations come a little bit more into focus. So, all right, well, Brett, with that, we will take a little bit of a break here. We will certainly be posting this to the site for anybody that might have missed it. Replay of it that should be going up in the next hour or so. And as per usual, if there's any questions, feel free to write into Brett and myself. All right, Brett, we'll talk to you later. Thanks again for joining us
Okay, you
as
got it.
per usual. All right, talk to you soon.
Thank you, Gav. Okay, take care.